Okay, the Libor. What is it? The Libor is the London Bank interbank offer rate. And it involves really 16 banks, and they're divided up into quartiles. So they take these 16 banks, and the middle quartile is, they could divide them into fours, but the middle ones that come up, you have the banks with the highest Libor rate, the banks with the lowest Libor rate, okay, and they take the middle couple, okay, the middle two quartiles right there. And the theory is if they do this, what it does is makes it so banks can't collude. So this is the top banks, the bottom ones. So we'll say the top quarter, top Q, okay, bottom Q, bottom quarter, bottom, and there's 16 banks. Now these banks set the Libor, which is a borrowing rate. But let's see how Libor affects the world, everything in the world. Well, it affects stocks if the interest rates go up, because Libor's interest rates, it's loaning rates. It's the rate set for the 16 core currencies. So I'm going to bring this over. Those core currency, well, not 16 core currencies. Let's take the dollar index. Dollar index is Euro, USD, and then you have GBP, USD. It sets the borrowing rates between the Euro and United States, the GBP in the United States. It sets all these lending rates. What are these lending rates used for? Well, they're used for borrowing rates between banks. So I guess I could list them right here. Borrowing rates between banks. They're used to value banks, set savings rates, or saving rates of interest. Bonds, they're used to set bonds. They're used to set Forex swap rates. They're used to price in. There's about 600 trillion in derivatives. And a derivative just means like you might have a stock and then have multiple derivatives on the stock. So it's a factor of the other ones. Most of this, rumored 2/3 are interest rates, because interest rate swaps. Now, since this values a bank, let's go right to banks and loans and talk about how the Libor works. If the interest rate drops and they have old debt that is paying 6%, 8%, 5%, it's good for the bank because the value of the bank goes up. The new debt doesn't really help them. The old debt makes it so that they have good income streams compared to the new debt. It also spikes the stock market, which helps them raise their stocks. So if interest rates are down, stock market goes up. If you get, for example, an increase in rates to the downside, or a decrease in rates to the downside, commodity prices will drop. So all these green ones you pick up in real estate, pick up in commodities, you're going to pick up in stocks. And you'll value your banks higher if there's a decrease. So it does help the banks. And if it rises, the old debt, it hurts the bond market really bad. What is QE2 an Operation Twist? The Federal Reserve took the bonds off the books of the banks, and they took the bonds off of, or the mortgages out of the banks, and they put them into the Federal Reserve, which is like a legal institution. That legal institution holds those sources of income, holds all the notes on real estate, okay, big time. So as it holds these notes on real estate, they didn't have to pay anything for it. They just printed the money. The printing of that money, the only way they can get away with it is because of the Forex market. Now, we got to go over here and we got to learn some stuff about the Forex market, and we're going to grab this. Basically, if we take real quick a bank, and the bank is, I want to circle here. If we take a bank and we take the Bank of Mexico. When I was growing up, you could go to Mexico, you could pay a girl $10, she'd rub your back, just your back, she'd give you a case of beer and, well, 10 beers, a bucket, so 5 beers. So you could get 5 beers, a back rub, and dinner, okay, for $10, because the Mexican peso was so devalued. Well, everybody wanted to leave there. They couldn't live, and so they came to the United States. Well, the problem here is we had a lot of freedoms, and we had TVs and a lot of consumer goods, and the lifestyle looked a lot better here. But their banks had a problem. All over the world, they have problems. So let's take 3 different sections. Latin America. Let's take Asia, Okay, let's take South Africa. All of these guys decided, and if you took Zimbabwe, for example, their currencies became worthless at one point. Well, a European bank could come in and say, I'm going to buy up all your diamond mines or your oil fields because it's dirt cheap. It's dirt cheap. Great. Okay. The owner of that diamond mine or that got rid of it because they got euro dollars, but the Europeans took it over for pennies on the dollar. Pennies on the dollar. Okay. That'd be fine if you got paid in euro dollars if they continued to go up in value. So what the European banks do is they have these things called Forex. Now, Forex is a hedge of debt. It's really important that you get that. It's a hedge of debt. If you take a Forex contract and you put this on here and you put this on here, you're taking a loan out in one country and you're loaning it out in another country. And all you have to do this is pay margin. So unlike the other instruments that we trade, Forex does not have, your counterparty does not lose. Okay. So if you take Forex right here and you come over and you say, okay, look, I have a foreign currency right here and I'm going to, trade it. I'm going to borrow right here from the Americans, let's say Japan, and I'm going to loan money out in Australia. As I loan the money out in Australia from Japan, basically what happens is this is really important, because when this money's loaned out, there's a swap paid, and that's the Libor. They pay it. You're going to have a borrowing rate here and a receiving interest here. Well, all the banks are out is the interest that they pay you. This is really important. They don't like this. But you put a margin on this loan. Well, why would they take your loan with margin on it? You're going to take out a $100,000 loan controlled by margin. Why would the counterparty, the bank, accept your loan? Well, it's really simple. You have created money by taking out a loan. They want the euro. They want 1 million euro, 1 million yen, 1 million. I don't know, Swedish pounds, anything. They want 1 million Canadian. They want 1 million of everything. If they have income streams in loans from all the different currencies, they don't get devalued any differently. This is important because if they got devalued, there'd be a big problem. All right. So basically what happens is the banks need your loan to balance their books. All right. That's why they're hedging debt. That's why they're your counterparty. Now, as they take this debt on to their books, they may keep it a little bit or sell it or get rid of it because they need to keep their books relatively flat so they don't get taken out by another bank. All right. Now, that's why they're the counterparty. The risk to them is nothing. To them, it's nothing. So there's no limit to what you can make. So if I share you my best systems, it doesn't matter. It doesn't matter. So I'm going to show you one of my better systems. But you have to understand the world first. To understand the world, we're going to come up here and we're going to look at something. We're going to talk about the dollar index and CRB. Okay, these are things that happen. If the dollar drops, the CRB index, which is metals and oils and golds and goods, goes up. If the dollar goes up, then the CRB goes down. The reason is because all of the commodities are priced in dollars. All right. Now, why did they do that? Okay, so back after World War II, people were in a really bind, and they've always looked to America because of their freedoms, because of the things they have, and they're like, that is a really cool place, America. And so they didn't mind making it so that in their countries you have to buy, and let's pull this back here. We'll talk about that in a second. They didn't really mind saying, okay, I need to get oil, but I only want to accept US dollars for oil because our currency was strengthened. No big deal. No big deal. So this is called a petrodollar. You take US oil to oil has to be paid for in US dollars. So what if the Sauds, which they have their own sovereign country now, and this sovereign country decides that they will no longer price their oil, and it's their I don't even know what the name of their symbol is, but if they said we're going to price oil in this, why would they not do that? Well, there's two people that tried to do it, Hussein and Gaddafi. They both died, and Ahmadinejad's trying this. They want to price their oil in their own currency, because then it would force the U.S. to go buy their currency, strengthening their currency. Right now, everybody has to hold our currency. Well, if we come back here and we talk about this circle, how the banks hedge debt, sovereign nations, basically, what they want to do is they don't want to be married to just dollars. If they have just dollars on their books and their currency, so you have like Mexican peso, MXN, and Euro, US dollars, you don't want that. Mexican central bank has finally said, we will not accept remittances from our migrant workers from the United States unless they're converted to pesos in the United States, because they don't want US dollars. So this is causing a very bad devaluation in the US dollar, because what's happening is these countries want to act like a central bank. They want to trade with other countries. And what if they had some Japanese yen on their books, they had some euro on their books, and they had all kinds of stuff on their books, meaning this is how you were brought up to think that the market works, but it doesn't. You're in Mexico and you're going to sell your good of oil to the US or to Europe. Well, you would think whoever pays you the highest price, you're going to sell it to minus shipping. Well, if you sell it to Europe, they have to pay you in US dollars. Oh, wait a second. That's not a cool thing. That's not cool at all. Okay. Okay, hold on. Okay, sorry. Now, imagine that you're a Mexican national and you want to sell to US or to Europe, but you need to be paid in US dollars. Well, our fiscal policy totally affects that. If we print money, it affects it. The value, buying power of our dollar goes down, and the cost of buying the good is going up. This stinks. The cost of buying the good is rising. They don't want that. So let's take, for example, Australia. Australia has said that they're going to settle some of theirs for yuan, and they're going to settle some of theirs for Japanese yen, because they want to act more like a central bank. They need this other debt on their books to prevent them from getting burned. Okay, so this causes a problem. Because they put this money out there, what's happened is we're coming unhinged from the dollar. When that happens, it's totally possible for the dollar index to rise and the CRB to rise. It's a perfect example, perfect storm coming up in here. The Libor is going to be jumped because the attorneys generals that are investigating the Libor scandals are going to force it to fair value. That'll send it up. Now, regardless of the price of our currency, we're just comparing our currency to other things. The cost of commodities could go up just like it used to do to other countries. So we're in for a comeuppance on this. So I'm going to teach you a little trade. Since the banks have to keep their stuff like this, what you can do is you can take something like, let's take GBP and let's take Euro. If the Euro and the GBP get too far apart, meaning that they have a normal spot, they stay together. They're highly correlated pairs because they share a common border. If the Euro comes to the bottom of a Bollinger Band and or the GBP comes to the bottom of Bollinger Band, Euro comes to the top, they're going to come back together. That's called a variance trade. This also, though, happens with things like CVX, which would be a oil stock, and US dollars. So the reason I'm going to bring this up is because this is really important, because this is how the world works and how companies make money. If you were to take CVX, and you were to take over here oil, USO, and you found a time when it was at the top here and at the bottom down here, so right towards the top there, or outside the Bollinger Band, and this one's at the bottom, you start to buy USO and you sell CVX. And as these variances get too far apart, you sell it until it comes back together. They will snap back together, and they did. This one dropped and this one rose. You'll make money doing that. It can take months to do it, a couple months, but they have to come back together because CVX uses oil and US uses oil. But they're both priced in dollar right now. Okay, there's another way that this works. These are called variance trades. This is Apple, and this is the SPY. Okay, if you take Apple, and Apple comes to the top or bottom of its Bollinger Band, and the SPY is at the top of the Bollinger Band, what you do is you go long Apple and short the SPY, this starts to pull them back together. One of the two is going to rise. They're very low risk trades. They're called variance trades or pairs trades. Now, those types of trades can be done between currencies now and through the stock market, and it can tell us the highest valued currency. How do we use that in, for example, real estate? You would take and divide out the currency that you have. You would take whatever the value of your currency is divided by the real estate, and you could see if your currency that you want to market to or sell to, like British people or Canadians, has a stronger currency or not, because that's where the buyers are going to come from. The strong currency is going to come in and buy your goods or service, because that strong currency is going to come in and buy the bottom, and then the weak currency is going to be the seller, and then eventually those switch. So let's talk about really how gold and silver work, because most people, 99%, don't get it. If you take gold and silver and you say, okay, I've got gold and silver, it's a fixed amount of gold or silver. Well, here's silver. Okay, here's the euro. Euro goes up in value. Euro shoots up in value. Well, that means the dollar shot down in value. It means it's okay for Europeans to buy U.S. silver. So they buy U.S. silver, and then the sellers are U.S., the buyers are Europe. When it switches, the buyers are Europeans over here, and the sellers are the U.S. or vice versa. Depends on the strength of your currency. So the same silver runs back and forth between the two. Now, as the dollar comes unhinged, there's ways that we can trade this. You could do a variance type trade like this. So this would be a simple beginning variance trade that we can't do it. Step one is we scan for dollars, something correlated in dollars, something correlated in oil, something correlated in S&P. Okay, what is the weekly correlation? You try to find out what that is. And then if one of them's at the top of a Bollinger Band, you either go long stock on one side or short stock on another side, or you buy a put or you buy a call, and you do both of these together. These are paired together. This is if the Bollinger Band's a 1 standard deviation Bollinger Band, maybe you'd think about this. If the Bollinger Band's a 2 standard deviation Bollinger Band, you would think about this. You'd buy both pairs. If it comes down here and you're an option trader, you may do a back spread. Okay, so we put this back up here. You may get a back spread. This is maybe if it gets 3rd standard deviation, you're betting for it to come back. Okay, you can find these types of trades. They're a little harder and a little tricky. These are normal ones. This would be U.S. dollar, U.S. company buying oil. The abnormal ones that are coming around right now would be something where you would take, for example, I believe strongly that soon through ETFs, and we can already do this through ETFs, I can buy, depending on the broker, euro-priced silver, or I can buy or sell U.S.-priced silver. Well, this has never happened. How can that happen when the silver has to be priced in U.S. dollars? Well, it's not going to be. This is a concept called a triangular arbitrage, and it's the where money moves. Same with real estate. You hold real estate right here, real estate. Okay, now if you're holding real estate in the United States, and instead of silver, you're going to move your money and say, I want to sell to a European because it's cheaper, because their currency is worth a higher price to buy U.S. real estate. Okay, the value of these currencies is what makes the world go round. Well, normally the U.S. has had a corner on the market where we could not as a country, people could not buy oil priced in euros. They couldn't. It wasn't for sale. They couldn't, like we normally thought, do that. It wouldn't happen. But these types of trades are coming out now. Now, that's what how the Libor affects the markets.